You guys wanted me to break down my swing trading strategy. I put out a poll on Instagram and it came back with majority of people wanting me to break it down. So guys, today I'm going to be breaking down my swing trading strategy and I'm going to keep it as simple as possible. I used to be really up in my feelings, really up in my emotions when I was swing trading. The moment I would get into a trade, I would want to close out that trade early just in case it could turn back on me. Sometimes I would hold a trade for days, only for it to come back and hit my stop loss. Sometimes I wouldn't even move my stop loss, because I believe I had to be off that belief system that price would never come back. It will never come back. And guess what, guys? It came back often. So today I'm going to be breaking down my new swing trading method. When it comes to swing trading, the very first thing you do is you look at the higher time frames to understand the trend. I know some people say the 4-hour time frame is the higher time frame. No, it's not. I don't know where you got that from. The daily and up is the higher time frame. So am I going to look from weekly, the monthly, the daily? Which one? I personally like to use the daily time frame for my direction, and so this is what we're going to be doing now. You can see I'm on the daily time frame now for Euro USD. First off, we can zoom all the way out. I'm on a daily time frame and I'm trying to figure out what on earth is going on here. I understand that we have a large push higher, a retracement, a push higher, a retracement, and a push higher, but then this time we run through this low over here. And so for me, then that means we are changing direction. Price doesn't move in a straight line. Price is going to just move just like this, guys. Up, down, up, down, up, down. And sometimes, just so you guys know, it doesn't always expand, retrace, expand, retrace, expand, retrace. It could go expansion, then it will just sideways, expansion, sideways, expansion, sideways. Oh, I messed up the last one. Let's do that again. It can go expansion, sideways, just like that. Then expand again, sideways, and then expand. So basically, just so you guys know, and just so you guys understand something, because I always used to believe that price does this one right here, this one right here. I always used to believe price does this one. I started noticing price does this one too. And really and truly, both these two, the agenda is the same. When price is running up to the upside, when it starts retracing and doing all these high lows, it's just to generate money on the top side. Let's see if I can draw the money all on this side here to then take it out later. Same thing here. Look at this. Obviously, when price is moving up and down, it's going to be moving up and down like this. Yeah. There's going to be money beneath some of these lows here. It will drop down, take out the money beneath these lows, and then go back up. But generating liquidity as we drop to then run it later. Same thing here, guys. Look at this. When price expands, normally after an expansion, you're going to get what? Some type of consolidation. And so you get a bit sideways action. And so what's going to happen is going to be money on this side, and there's going to be money on this side here at the bottom side too. And so what would happen, sometimes this last drop before the rise is normally a little bit lower to run out some of this money, and then we go higher and run out the money on top. Same thing here. Just like we were doing on the left side, we're generating liquidity to run it later again. And then the moment price runs beneath this low here, this is when you can start thinking price could retrace and then drop even further. I know I've messed it all up, but let's just leave it like that, yeah? Same thing here. The moment price, I don't know where this one ends right now. The moment price runs beneath this area of consolidation, this then means that you can expect a retracement for the drop or expect consolidation before another drop. This is what I'm trying to identify when it comes to understanding direction. Just this. I could show you the other side of this. I could show it to you in a sell side, but guys, just flip it around. Your grandma can do it. I don't need to zoom all the way back here. I already understand prices dropping for Euro USD. So now when we zoom in, what do we see on Euro USD? We see price make a move up, a move down, a move up, a move down, a move up, a move down. Then we have a large move up, all of this, and we have a move down. And then I'm just going to do it anyway. We have another move higher, so another expansion higher. And then what do, guys? We break or trade beneath this low right here. So guys, you can see here we trade beneath that low. What price is doing is it's expanding and then retracing back down into a discounted price, then expanding again, and so on and so forth. It will continue to do that until we run past one of these lows here. And so then when price runs beneath this low here, that's when you can start expecting some kind of retracement higher. If I zoom in just a little bit more, what do you see now? You see how here we were expanding up higher and retracing, expanding up higher and retracing, and so on and so forth. Here, what do you see? You see an expansion lower, consolidation, expansion lower, consolidation, expansion lower. Same thing. Knowing what we know now, we know that price is retracing up into a premium price, potentially for a drop. So that means where is a premium? This is when you bring out your Fibonacci tool, take it from the top to the bottom. You can obviously eyeball it. Eyeballing it is not necessarily going to be the most accurate, but a premium price is anything within this area right here. So all that means is that from this high to this low, this whole move down, if you marked up 50% of the whole move, that is this upper portion, and that is when price is at a premium. So when price gets up into here, it's at a premium price. So once it gets into that premium price, this is when you expect price to drop. So now you've identified the trend. The next thing you have to do is you have to identify where you are in that trend. Where we are in this trend right now is that we've reached a premium price. If we were beneath this low, we'll be at a discounted price. The ideal for a short would be from a premium price. Now, when it comes to entry, what I like to see is this. I like to see price make a large move to run out one of these lows here. When price was expanded higher, retraced, expanded higher, retraced. When it started to expand, it never ran out the low. In fact, it took out this low here. So I like to see a large candle take out that low. Price would leave some inefficiency here. An inefficiency is just another way of saying an imbalance or a fair value gap. So I've just taken a little bit off the screen. Your boy was talking too much. I didn't even take off the screen. But anyway, guys, so when price expands beneath this low here, it leaves an inefficiency here, guys. So what I'm going to go ahead and do then is I'm going to go ahead and mark up that area of inefficiency. I'm going to shade it in a different color so we can see it. If I mark up the high of this to that high here, it's about 20 pips. I'm not one to do a 20 pip stop loss. I'm not one to do a stop loss that large. If this was a lower time frame or if the imbalance was a lot smaller, let's just say it was a 5 pip imbalance or maybe a 10 pip imbalance, maybe we can work price trading up into 50% of this and then dropping. But really and truly, you don't know how deep price is going to run up into this imbalance before dropping. And so what would you do then? This is when I would go down to a lower time frame to try and refine this area or to see what price does when it gets to that area. I'm on a 1 hour time frame now. So now this is my gray shaded area. This is my imbalance or my fair value gap. You don't know how deep price is going to run into this. And so your best option then is not just to jump in straight away. But now when it comes to another part of my strategy is this. If I want to sell, I need to see price run a high first, take out that liquidity and then drop beneath this low here. I like to see this happen first before I get into any trade. What I don't like to see is this. I don't like to see anything like this and then a drop, because there's going to be money left up here and that would always make me uncomfortable to sell from anywhere near these highs. I like the money to be taken, you can see, taken first before selling. So the moment they run out liquidity, they take that money and then they drop. I don't want to see this. I don't want to see this either. I don't want to see this drop here, because for me, once again, there's still money above here. The best ones I like to see is this one. Second will be this one, and I just don't like this one whatsoever. This is the one I normally trade towards. This is Friday. Let's go ahead and mark up a day, just so you guys know where the day ends. So this is the new trading day. So my arrow to the right of this is my new trading day. This is the previous week. This is a new week. My trading strategy then would be to run a high before going short. So the higher I've identified is this one right here. I would want to see price run higher and then drop. So let's hit play. So we run out that liquidity above here. Buy stops is just another word for liquidity. It's just liquidity in this area over here. Activate those buy stops. So we're going to be stopping people out when we run higher above this level because they think the level is going to hold. I'm also going to be activating people that do breakout buying who believe price is going to run higher. So that's the whole point. And then in this area here, this is when you're looking to get active. The 1 hour time frame is not what I use, but I just wanted to show you guys that we ran higher above this high. So I go from the daily time frame. And when it gets into my daily POI, this is when I go to the lower time frame, like the 1 minute time frame, to catch an entry. So let's go ahead and look at the type of entry that was provided here. And basically it was the entry that I took too. The trade I'm referring to is the one you're seeing on the screen right now. Let's go to that 1 minute time frame. On the 1 minute time frame, when price got up here in the London session, that's another key thing. What did we see? When price gets up here, we want to see some kind of reversal. This is the reversal that I'm looking at. We didn't just see a running of liquidity on the 1 hour time frame. I also want to see this on the 1 minute time frame. So just so you guys know, this was it on the 1 hour time frame. There was a high and the high was taken out. Now I want to see the same thing on a 1 minute time frame. What do we see? So let me zoom in. We see highs up here. We run higher and then we drop. This here is called a up close candle. This is an up close candle from here to here. We run out liquidity to the left and then we drop beneath the low. When price retraces back to this up close candle, let's go ahead and put an arrow on. This is when I'm looking to get active. Because we're on a 1 minute time frame, we're able to catch really small stop losses. The high was 2.3 pips, guys. 2.3 pips for that high. And don't forget, guys, it's not always going to be like that. It's not always going to be a 2.3 pip stop. It could be a 5 pip stop loss. You could have it above this high. Because the stop loss is so small, you can even have a 5 pip stop loss and still be Gucci. But anyway, guys, let's zoom in. And then what you would do then is from this level, you would run it to the swing low because you are swing trading. Back to the low down here. This is when ideally you would run it to. And don't forget, let's just zoom back out a minute. We're still so far away from here. We don't have to take it down here. And that's the beauty of swing trading. You don't have to take it down here. This is a huge move. We're talking about huge moves from this high to this low. We're talking about 290 pips, guys. 290 pips. So you don't have to take it down there, but let's go back to the 1 minute time frame. So this is what I will do then. Once we get down here to these lows, this is most likely when I will take partials off the trade. And when I say take partials, I'm taking off 80% of the trade and I'm leaving 20% to run to the very lows for the swing trade. Let's just hit play a few times. So I'm in a 50-minute time frame. Just going to the 50-minute time frame, you can see, look, we run out these lows right here. These are our relative equal lows. There was going to be money beneath that. The sell stops beneath that. We run out those lows. This is when you take partial profits and then you let the rest ride to see whether you can get down to the very lows itself, all the way down to these lows. Like I said, this is a 200 pip move from where we caught it, but there's also money down here. There's also money beneath this low, these lows. Either take more partials as price runs out these lows, or you can add more positions. And when you add more positions and it runs out liquidity, take off partials of 80% and you let 20% ride. It's a little game for me. I like to build up as many partial positions until when it reaches a full position and see how many times I can do that. There's a little thing that I like to do. You don't have to do that, by the way. You can swing however you want. This is how I personally swing. So this is why sometimes you see me in multiple positions when I'm posting on Instagram. Most of those trades are partial positions. And the reason I even do stuff like this, the reason I don't hold a full position, and I know there's some people out there who talk about holding a full position for the full swing. I used to do that back in the day and it wasn't necessarily the best all the time. But guys, the reason I do that is because when I take partials, all my emotions leave the trade. All my stress leaves the trade. I'm not saying I jump in stressfully, but when I was jumping in stressfully back in the day, I'll be emotional throughout the whole trade. And I would always think price is going to come back and tag me out. Operating on that mindset makes you want to exit the trade early. It makes you second guess yourself. So what I decided to do was I'm going to take partials and let the rest ride. And of course, I've held swing positions, full positions for swings. Of course, I've done that. Just because you aim down here doesn't mean you have to end the swing here. This could be the full range and you might want to end it down here. You might want to end it after a couple of days. Sometimes I close out a trade and add in another trade to take it to the next potential area of interest or TP area. That is my swing trading strategy, guys. Hopefully that helps you guys. And my last tip is don't be pressured to hold a full position all the way. It doesn't make you any less of a trader. Take your partials, remove those emotions, and keep it moving.